Hi everyone, welcome to Locals Supporting Locals. Today is a super exciting day for us because we don't only have the panel, but we also have the party later on this evening. Finally meeting some of you guys face to face, which is really awesome. Whoop, whoop. We are here with Mark Robinson from the International Academy of Wealth. Short disclosure, also a joint venture with me. So the reason why we have him here for Locals Supporting Locals is he is the mastermind behind International Academy of Wealth, but also here locally in Tauranga, New Zealand, with members represented in Tauranga, actually. So I do believe that very much a local, and he is a Kiwi, even though we will forgive that he lives in Sydney. He is a Kiwi, a Waiuku boy. So welcome, Mark.
Thank you. Thanks for having me.
You're welcome. And David, we have David. I'm pretty sure everyone of our locals will know who you are, but financial advisor here in the Bay. So I love the fact that today we're going to be debating everything money. So, you know, normally a taboo subject, most people don't talk about it. But today we will have Mark and David talk about money and investing and what to do with the downturn or with the upturn, whichever way we want to look at it. First up, hi Tim, welcome to come for you to join us. Awesome to have you back. First disclaimer, this is not an advisory session. This is an educational session. We're all going to have an opinion. So please do your due diligence on your homework. Mike, you'd be so proud of me saying this right now. Your own due diligence and homework.
Yes, this is not a financial advice session.
Absolutely, it's not financial advice, and it is not covered under the financial advisory regulations. It is just us all sitting here having an opinion about money and investments. Are we all cool with that? Yeah, Tim? Awesome, fabulous. You're the representative of everyone who is watching. So welcome to, who are we going to start? We'll start with David. David, share a little bit about your background, why you have an opinion on money, and why you are the right person to give us your view on money.
Sure. So I'm an investment advisor based here in Tauranga. Hobson Wealth is the firm I represent. So we opened the office here about 18 months ago. We've also got offices in Auckland, Wellington and Christchurch. So our home office is up in Auckland, and we've been going for over 20 years. So some people will be familiar with the Macquarie Bank brand, so a big bank over in Australia. They owned the private wealth business that's now Hobson Wealth for some time, and saw a few years ago the reason to get out of the, I guess, the distribution of advice. So where there was a management buyout around 4 years ago. So Warren Coolio, our managing director, he organised a buyout of the business and then sold down about 2/3 of the business to its staff. You know, so we're a boutique firm owned by employees. So we've got a vested interest in making sure that our clients are getting the right investment outcome, the right advice and portfolio. And I was previously at one of the big banks, spent about 10 years in banking with that particular bank, and I've been in the industry for over 20 years, working in Australia as well, over in Sydney. So fair amount of experience helping people with their investments, seeing the good, bad and the ugly of the likes of the GFC, and then interesting times this year, right? So I've navigated clients through those times, and really keen to make sure that people have a good strategy in place to achieve their goals.
Awesome, thank you. And Mark, you went from years and years of financial advising to financial education. Can you share a little bit why you made that switch from advising to education?
Yeah, look, I think, I've been almost similar sort of story to David, been in financial services 26 years, worked for some big major corporations. In fact, the last job I had was Suncorp, was about 8 weeks. They made me turn up every day, which was frustrating. So I've been pretty much self-employed since I was about 21. And look, the main, and we were talking about this just off air, right? The main reason why I moved from financial advising into the education space is I really believe that those that seek advice are seeking someone to blame, right? They're not taking that responsibility. And those that are seeking education are actually looking to take that responsibility on. And the funny thing is the people that are looking for responsibility, there's far fewer in the world than those that are seeking blame, right? And I think you can just jump on Facebook any day of the week and you can see people just wanting to blame someone else for where they are in the world. So that was the main reason, guys. The other reason too is it's very restrictive. And David, I don't know if you know what the licensing's like in New Zealand, but here in Australia, it's becoming more and more restrictive. In fact, to the point that even if an advisor doesn't do anything wrong, right, they can get sued successfully, right, which just does my head in. So, you know, in the education space, where we can pretty much say what we want to say, and I do, as Paulina would know. So I can actually have an opinion in the education space, whereas an advisor here in Australia, you know, our opinions were curtailed. And it was very hard to find an actual licensee where we could actually be independent, right? A lot of people don't realize, but 98% of all licensees are owned by the major banks and industries. So, you know, what sort of independent advice can you give, right, when you're like that? And I think AMP is a classic example. Most of their advisors, 99%, you know, sell AMP products and they don't work. It's as simple as that.
Yeah, the regulation that we're seeing over here, Mark, is I guess it's the double-edged sword of trying to protect clients and ensure that they get good advice and good investment outcomes, but ultimately it drives the cost of providing that advice up. And so you end up with that consolidation in the industry. Smaller independent advisors get out because it's perhaps they've got enough grey hair now that they don't want to go through another round of regulation. So they get out and you get that consolidation and some of those conflicts that come through. And we're going through that next round of regulation that'll bring us into a similar arrangement that you have there in Australia. And again, it's designed to help investors, but you know, will perhaps lead to, you know, perhaps a reduced amount of independent advice, I guess you might call it.
Well, the frustrating thing is people want to come to you for advice, right? And you can only give advice on whatever is on your approved product list. So if I wanted advice around cryptocurrency, you probably can't give it, right? No one in Australia can if they're licensed, you know, so, or direct property, you know, again, most advisors can't give advice around, you know, things that are working.
And I guess for me as an advisor, it's really important to be able to walk the talk as much as talk the talk. And I guess that's why I made the move out of banking into a firm, into the Hobson Wealth firm, so that rather than peddling a particular product and only having A, B, C, D and E fund and just trying to poke you into the fund that suited you, we have a wide open menu of investments. You know, we can tailor that down to the individual clients, and we're not incentivized to go with one or the other. So because for me it's really important that clients get the right outcome in terms of their investment strategy.
So what if cryptocurrency is something that they should have?
I don't even have to ask questions anymore. I like this.
No, I was actually going to move David and Mark into that area. And if we were to split investment into a few packs, like for example, property, shares, cryptocurrency, where do you think the future is? But I'm asking that question and then I'm questioning myself actually if it's relevant. But yeah, let's just unpack those different pockets of investment types. And maybe what's your predictions and where do you think things are heading, for example, with property to start with?
So Valerie, I think, and this is where it became frustrating for me as an advisor, right? And to me, the strategy itself should have nothing to do with what asset class is going to go next or whatever. It's about knowing where you want to be, knowing does everyone know what their financial independence number is? Right? Mm-hmm. So what is it going to cost to run your ideal life? And that's why a lot of the things like The Secret and you know, affirmations and doing all that visualization, it's a load of shit if you don't put an actual financial figure to what it's going to run your life, right? And then you've got to know exactly where you are and build your portfolio around what you're trying to achieve. Yeah.
Yeah, for sure. For sure.
Because we can talk about asset classes and we can do this, that, and the other. But at the end of the day, property may not be, like, I don't own any property anymore, right? Haven't done for about 4 years, and probably won't buy back into direct property for probably another 5 years when the market shits itself and we're going to pick up $2 million houses for 700-800 grand. You know?
Mark's had I suppose Mark's touched on the key point there, is that it's very easy to start putting the I guess the you know, the cart before the horse, and start looking at, well, which investment should we have? And conversation's got to start with, well, what does your money actually have to do for you? And I guess having money and having enough money is it's a relative conversation, and based on, well, what does it need to do for you? What are you trying to achieve? You know, is it retirement? Is it some other sort of target? What does that look like? And it's really important as an advisor to be able to help clients understand what the future looks like, and then break it down to what is the strategy that's going to help you know, achieve that. Because, you know, someone might be interested in cryptocurrency, but you know, if you look at what you know, how they fluctuate from a day-to-day basis, it may not be the right place to put your money in if you're going to pull it out next week to, you know, go and purchase a house. So it's important to look at what's the long-term strategy first of all, and what is your risk tolerance and appetite for risk.
Yeah, for sure. I guess what I'm trying to do is I'm going to narrow it down, and you're absolutely right. And in any kind of advisory, that's what we do. We assess where we are, we assess where we're heading, where we want to be. When we're trying to you know, find that measurable goal, and then of course we're closing the gap. But say, for example, we've done that job, and here's the client, and they know that they want to exit. So, for example, they're full-time employment in 10 years' time, and they've got a bit of cash happening right now. So, where would you lead them? What's the suggestions or advice you would provide to the clients there?
I think before we go into this question, can we unpack the asset classes and the investment classes we have? So, Mark, you were talking about various different strategies, and same with you, David, different strategies for where you want to go. But can you share with us, like, the classes they are, and when are they good for? What kind of strategy are they good for? If that makes sense.
Yeah, so look, we're completely different at the International Academy of Wealth. So most people think their asset classes, property, shares, what have you, whereas we actually build them into what we call the wealth pyramid, right? And the reason why it looks like a pyramid is because of the amount of percentages that you build your portfolio with. So our asset classes are foundational assets, and that can include, you know, basically you're looking for a targeted return and the time frame that you're going to keep them. Yeah. So foundational, for example, you want to keep them targeting, say, 5 to 12% per annum, and you want to keep them forever, right? Then the next class, we call them wholesale assets. Next one is targeted or focused asset sector. Then we have active trading, wholesale cash flow, and early stage, right? And they are all the parts of the wealth pyramid. Now, I've used those words to suit what we do, but that actual wealth pyramid was built by, or he called it the investment pyramid by a guy called Harry Markowitz, who's a Nobel Peace Prize winning economist, right? So I'd like to take you know, credit for creating it, but it wasn't myself. Yeah. So I think, and the reason why we're getting such good results versus when I was a financial advisor is because the asset classes, when you look at it more of that pyramid style and you build your portfolio percentages first, then you worry about the strategy. Yeah. And I think a really good, you know, soon as COVID hit, you know, we were talking about buying the big 4 banks here in Australia and airlines, right? Now, I know that a number of our members have made 100% plus returns in airlines, right? Even though, you know, the share market had shat itself during that period. So you got to look at, and I know that I'm not trying to avoid the question, because I'll easily tell you whether you should go into property or whatever, but the old method, right? And the way that we've been educated around money and building a portfolio is completely wrong, and it hasn't worked. If it had worked, right, there would be more people that would become wealthy and financially free at the end of it, right, than what is actually happening. The stats haven't changed in years. Over 60% of people are going to retire broke, right? And at the other end of the scale, less than 1% are going to be rich. 5% going to be okay. So if the old model that you have to teach as a financial planner works, then more people would be well off. Yeah. And that's why we wanted to change the model from like a circle and a pie to the wealth pyramid. And you can tell I'm getting a bit sort of heated about it. Passionate, right? Because it's the same bullshit that gets peddled, right, throughout the old system. It's why the economies around the world are crumbling right now. It's why the governments around the world don't work. I mean, you guys have got a minority government, yet you've got a dictator who can literally tell you what to do, right? It doesn't work. So we need to create new models, and there are new models out there that are working. We just got to get it out there in a better format and faster.
So
Mark, it's great that you've gone from financial, political, and pyramid schemes in the last 20 minutes. It's fantastic.
It wasn't even 20 minutes. So David, back to you for a second.
Yeah, let's go to David.
Yeah, can you share with us, like, what's the model, or what are the, you know, asset classes, etc.? You can tell that Mark is really passionate about it, but let's give you an opportunity. So share with us, what does it look like for you?
Sure. So, I mean, we're helping clients understand what their objectives are, and we're building bespoke portfolios for their long-term strategy, right? And so the old view and the view that we work to is there's really four main areas people will invest their money in, and that's cash, fixed interest, property, and shares. And so to sort of, at a simple level, we look at cash and fixed income as being defensive assets or income generating assets, and shares and property are what we would call growth assets. And so when we talk about cash, you know, people probably think about term deposits in the bank and perhaps a savings account. When we talk about cash, we're also talking about things like money market deposit accounts and short-dated cash securities with no maturity of less than 12 months. When we talk about fixed interest, we're not really talking about term deposits. We're talking things like government bonds and corporate bonds that are issued by, you know, your big companies. The banks are a good issuer, a typical issuer of bonds, as are your utility companies and some of our companies on the main board. And it's not just in New Zealand, right? It's all around the world. Mm. And so cash and bonds, they play an important part in a portfolio. Cash is really important for liquidity and being able to get access to money. And as we've seen over the last 10 years, the return on cash has gone one way, hasn't it? So from pre-GFC, about 8.5% to 9% on a term deposit in the bank, and you'd be pretty happy with that, to where we're at now, where you've got 0.25% cash rate, term deposits less than 2% per annum now, and the Reserve Bank talking about term deposits getting to zero next year. So that should concern anyone that's sitting on a lot of cash in the bank and expecting a return out of it. So fixed interest is the sort of next one up in the scale that I was talking about, and that helps people diversify their money away from just having some cash. It provides some exposure to credit risk. You know, you've got companies that are issuing bonds that are looking to, you know, if it's Auckland Airport, build a runway perhaps and fund that over a long period of time. So you've got some risk in terms of how they might implement that. And we mitigate that risk by spreading the money over a number of bonds. So you've got different companies in there with different terms as well, so that we're managing that duration risk. And investors that perhaps have a lower risk tolerance, don't like the ups and downs of the share market too significantly, are going to have more of their money in cash and bonds. But having said that, with central banks printing money and driving interest rates down by intervening in the markets to buy bonds to push interest rates down, that is forcing people to take a different view with their money. And you've got the Reserve Bank suggesting people should be buying growth assets. And I suppose, so that takes us to the other two assets, is shares and property, which are your growth assets. We call them growth because you're buying them with the intention that they're going to go up in value over time. So a volatile place to have your money over the short term, as we've seen, interesting start to the year on share markets. But the Dow Jones just had its best quarter since 1987. So that's the thing. You want to be careful about trying to time your move in and out of markets. So shares are going to give that growth over the long term. I think the New Zealand share market's probably delivered around sort of 9% a year for as many years as you can go back on average. And property is sort of similar. In my world, when we talk about property, it's not so much about buying physical commercial properties or rental properties or buildings. It's more about buying companies or listed property assets. And that's important to spread the money around and provide some liquidity. So when we build a portfolio, it's usually got those 4 asset classes in it, and the amount in each asset class will vary based on what the client's trying to achieve, that targeted return, and also their risk tolerance.
So David, Mark, just on from a business owner's perspective, or from business, when we're trying to increase equity or trying to increase finance, we've got some in growth mode, or we've got some assets to acquire, and we're looking for funding. Is there a particular class or portfolio where the banks are more favourable on versus, or they don't care because it's all about serviceability? Does the investments come into that from that side?
Look, I think they're always keener on property because you can get 80, 90%, even higher over here in terms of leverage. It's shares is normally 25 to 50% leverage on a share portfolio. To me, right now, especially here in Australia, guys, the banks are just looking for strong cash flow. And they've got government guarantees over here at the moment, right? So I can go to the bank, get up to 250 grand, no repayments for 6 months, and as long as I pay it off over 3 years, they'll give it to me, right? So, it's interesting times, and I know this is a local group, guys, but I think the thing that I'm passionate about New Zealand, because I'm still a Kiwi boy at heart, is the passion that we have for our country, right? But I also, the part that frustrates me about New Zealand is the ignorance around what's happening around the rest of the world in terms of investments, right? And cash flow. So it's like, it's torn between, asking New Zealanders to pull your head in. You're not the only people in the world, but also to keep that mentality of, and that protection of keeping New Zealand, New Zealand. Does that make sense, guys?
I would like expand on that. So what do you mean by New Zealand is ignorant towards the world? Like, expand on what you think about it.
And hey, just so you know, it's not just New Zealand. I have the same conversations here in Australia as well. And I'll give you, and I don't like quoting returns because people always tend to hold it to you. But look, we've had access to a product that has returned 15% per annum, has done for 17 years, right? And unfortunately, David could never recommend it. I mean, we don't recommend it. We just educate people around it. As an advisor, I couldn't give it recommendations, but this is a company that's gone from 0 to $1.2 billion and in actual value, and only owes less than 100 million bucks. So the exposure and the risk is very low, right? However, that company itself doesn't invest just in New Zealand or Australia. It invests in other parts of the world and has been able to give returns like that consistently, right, over a 17-year period. So you've got to start thinking outside the box because, and again, this isn't David's fault, right? But when I was an advisor, we were getting educated that a 9% return is good. It's not. It is shit. It is not going to get you to where you want to be in the shortest and the safest amount of time possible. That's a 40, 50 year product, right? At 9% return. That's going to take you forever to retire okay, not wealthy. That makes sense? So that's what I mean by the ignorance. You need to like expand your view. The cool thing about it is I actually support people like David, because not everybody, right, needs to or should be educated in what else is out there. We need to, some people should just be stuck in that bubble and let them get on with life and retire in 40 years time.
It depends on your risk appetite and your how much time you want to invest and responsibility you want to take, right?
Well, yeah, exactly. And I think risk comes down to education, right? Because people would think that cryptocurrency is high risk, but when you educate it and you understand that that's where the finance world is going, right? Like you can get cash returns at 8% in a decentralized finance world, right?
Mark, I think you hit on an interesting point there, is that when we start talking about investing in cryptocurrency, what do we actually mean by it, and what are people looking for? Are they wanting to have an exposure to a cryptocurrency and see it, the value of that particular currency rise and fall? Like a couple of years ago, every man and his dog was buying Bitcoin and encouraging their parents to loan against their property to buy Bitcoin, and then we saw a fall back, and that fallback was tied to Google and Facebook no longer advertising schemes promoting Bitcoin, right? So we had a huge amount of speculation. But then if we talk about investing in cryptocurrency because of where cash is going in the future, because of the blockchain and what that means for business owners and individuals and how we transact in the future, that's a different proposition from my point of view. And I think blockchain and digital payments are increasingly going to be an important part of our lives, and people should be looking at how that should fit into their portfolio.
Yeah, completely agree. Yeah.
100%. But you got to remember, way back then, right? Every man and their dog was getting into it. They were uneducated, they were idiots, and they were fear of missing out was more of the driver, right? Than those, like we were sitting on the fence, we were laughing, we were cracking up, looking at the rise, and we just cashed out and waited for it to drop because we could see it happening. Like that's the real key. Why are you getting into crypto? And when you think about it, when you look at the wealth pyramid, I'm a firm believer in Bitcoin, right? So I have a lot of Bitcoin in my foundational assets, but in reality, for most people, it should be early stage. And you don't have to put a lot of money into early stage investments to make a lot of money over a 3 to 7 year period. Right. And that's the big difference between the old way you build your portfolio and the way that, the new way to build your portfolio.
Can you, for those, I know what you're talking about, but for those who don't, can you define what an early stage investment is?
Yeah, I mean, it's things like, before, again, this is where the regulations are, changing around the world, to get into something like Facebook before it goes public. You now can invest in companies before they go public, before they're listed on the share market. If you'd put $100 into Facebook when it first kicked off, it'd be worth 250 grand today. So you don't have to put mum's house on the line to make quality money over the long term, right? And not every company you invest in is going to be the next Facebook. Yeah?
I think that it's a good point, because I'm pretty sure it must have been in one of our conversations here for Locals Supporting Locals. We talked about the regrets we had around investing, right? Like me and my zero. Like if I had just invested in zero when it was in front of me, I'll be a very rich woman right now. But at the time, it wasn't relevant, right? At the time, for me, it was too much money. I didn't want to invest in it. Now, 10 years later, I'm going, what the hell was I thinking? But hindsight, right? But yes, okay. So early stage is right at the beginning, like a startup phase of a business. Yeah, that kind of thing. Perfect. So we've just veered off. I love what you were sharing, Mark. And I must say, I don't know if I can say it's New Zealand ignorance, or it's just like the ignorance when you're uneducated around what's actually out there. when I started this educational journey 2 years ago, and found out like what investments are out there apart from, you know, your traditional, your KiwiSaver, you're going to your advisor, get some shares in property. I was just blown away what is actually accessible to normal human beings like us, right? When if you just educate yourself. But David, Tony, we had off so far. Can you repeat your question so that we, David, can, because it was a very relevant question and I would love to hear David's answer, but I can't remember what it was.
My question?
Yes.
Well, I guess Mark went on a good rant, which is great, but very relevant. It was just around, if we are sourcing finances or funding for business acquisition, growth, assets. You know, Mark mentioned most banks want to look at property. There's 25% to 50% equity in shares that they borrow against. So is just trying to say, is there better investments that we want to play to from a financial growth strategy for as small business owners? Should we be looking at that in particular, or the bank's just going to say, what property do you have? You know, because, and we've talked about it before, about skills versus expertise, and then other investments. And when you're trying to get other funding applications to get your business growth, what is there a strategy? Do you play that into any strategy for investment, or do you just?
Yeah,
David,
look,
big one to answer.
look, I think that the key is, and I think the biggest.
I'm sure I was asking David, Mark, but carry on.
Yeah. Look, I'll make this quick. I think the biggest mistake business owners do is put too much investment back into their business, right? They think that people want to buy their business when it gets to a certain thing. I went through them. It was a great lesson, but you know, I thought scaling up was the way to freedom. It turned out it was the way to jail, right? We just got locked more and more in our business. Now I have, you know, I had 13 staff. Now I've got a virtual assistant in the Philippines, and we outsource everything else, right? So I've gone from no freedom to all the freedom in the world. So I think what business owners should be potentially looking at is, before they even look to borrow money, is that same thing. Why are they doing it for? You know, it's not the be all and end all. But to actually answer your question, you should be looking for cash flow strategies, right? Because if the banks say no, then at least your cash flow investments will fund it for you, although it could be a little bit slower, right? But banks will primarily go for, you know, a traditional portfolio and property.
All right, David.
Yep.
Now it's your turn. Mark, if you say one more word, I'm going to mute you.
No, and the other caveat is, David, you can't agree with Mark.
So, I suppose from a bank lending point of view, and you guys are, you know, business owners, probably gone to the bank for a loan for your business. Banks always want the best and the most security that they can have for a loan. So, you know, they love residential property. And New Zealanders love residential property, so it's usually a one that they'll favour. And yes, you could probably put some shares up in a portfolio to get some loans for your business, and they're going to lend you less against those than perhaps residential property. And it comes down to risk and how quickly they can liquidate it, I guess. But I suppose it leads to an interesting conversation around, you know, whether you should be loaning against those assets or liquidating those assets if you need to be putting the money back into the business, or like Mark says, you know, should you be putting that much more money into the business? And I guess part of the answer to that might be around what kind of return can you get on that money in your business, as opposed to that portfolio or that property or buying other assets. And what we've seen in this year will certainly perhaps be a lesson for a lot of people, is the need to have, you know, a contingency and perhaps have some diversification. Most owners, business owners, you know, all their sweat, blood and tears and everything in the kitchen sink is in that business. And that's great if you can make that grow year in, year out. And arguably it probably is a pathway to having a really secure future, providing things go well. But imagine if you had a tourism business that was absolutely flying with all all the you know, the inbound tourism we've had over the last few years, well, your business is being decimated and is a fraction of its former self. So that's perhaps where you know, having some alternative you know, cash funds, investment portfolios, and a solution may be appropriate.
Do you think the banks will in the future, looking at the hospitality tourism sector, let's say we're in a tourism business and I wanted to get a you know, I was looking at a couple of new buses or a new ferry or even plant and machinery, and you know, would you guys, and I guess this is a twofold question, would you guys be asking now as a business owner, as you're going through some investment strategies, okay, what is your business going to be doing? How is that going to grow? Do you have any growth acquisitions? How are you going to fund that? Is that going to be through cash flow, or is that actually going to be through these asset classes that you're doing on? Conversely, and the other part of this question around tourism, for example, is do you think the banks will start looking at what other investments and serviceability options they have rather than just the assets? So yes, you have a house, but you're running this industry, you're in this business. If it all goes to pot, what other service options do you have? What other liquid investments do you have that you can back up with? They might not have a vested interest or an equity stake in it, but they're looking at the serviceability.
Can I just add something to this, because that is an industry, my industry, right? Like tourism and hospitality.
Yeah.
I don't think that I think that the banks will do this in any business after the pandemic. I think everyone goes like hospitality and so much more impacted. I actually believe this hospitality was one of the worst industry, and tourism was one of the worst industries when it comes to borrowing money anyway, because the margins are so low. So all those questions, when I think about the business owners I've been working with for the last few years, and they wanted to borrow against it, they already had that extra hoop to jump through, because the profit line is so minimal, and it is so it has so many impacts, you know, like so many things which can impact their business already. So I personally, but I want to hear David's and Mark's view as well, I personally think that it will get harder for every business owner, and I don't think it'll be specific for tourism and hospital, because they already experience this difficulty. But
Yeah,
David,
I guess just to clarify that a bit is, will the banks be looking at other investment vehicles rather than just properties for that serviceability, even though they might not have any sale or any borrowing against it? Yes.
I think, well, banks typically are looking for personal guarantees and recourse to other assets, aren't they? So I imagine that'll certainly be a feature going forward. And look, to be fair, I can't speak to the banks, but what I do understand is that you know, they are keenly interested in what does the future hold for your business, and whether or not that means you are going to have that servicing capacity. So credit will perhaps be tighter. And we saw it was a slow start with the government-backed lending out to businesses. You know, what was reported. So yeah, I don't think that's going to decrease anyway.
Mark? It's like,
I'm allowed to say something now.
Yes, you're allowed to say something. Look,
well, I think there's two parts to that question, right? New Zealand banks are going to need money to be able to lend in the first place. And I think you guys have got to realise that most of your banks are owned by Australian banks. You have a bail-in law. We have bail-in laws. We'll probably steal all your money anyway to prop up our banks before they get a chance to lend it out, Tony.
I thought you did anyway.
Yeah, we do, right? So that's something like, and you guys should literally check out the bail-in laws. Yours are actually far more stringent than ours. So be careful about how much cash you do have in the bank initially. But I can't see banks being able to actually lend a hell of a lot moving forward, you know, in the next 12 months, because no one can afford to pay it back, right? And that's where, you know, off air I was talking about borders being closed and that, and I won't go into the whole, you know, COVID thing and my thoughts on that. though, guys, there's the economies are going to take a, people need to, and this is what I've loved about what Paulina and Valerie and yourself, Tony, have been doing about getting people to change their perspective on what a business looks like, right? And that's going to be the key. And doesn't matter where you are in your business right now, if you aren't pulling some profit out and investing it in other income streams, you will fail faster than those that are already pulling profits out and investing in other income streams. It's as simple as that. You need to change your business model now. Last week, you know, simple as that.
I really like that point you said, that we have to actually take our paycheck as a business owner and put aside some.
Have to pay yourself first.
So what are your suggestions? Because, you know, the favorite book of all the times is Think and Grow Rich, and also The Richest Man in Babylon. I hope some people read it. So the philosophy there that you should take 10% always and put that amount aside for your investments. What is your percentage, suggested percentage there?
Look, it comes down to where everyone's different, right? And again, it goes back to where they want to be, right? And where they are now and how fast they want to get there. But at the end of the day, it comes down to education, right? The more education you can have around investing, around business, you know, the faster and safer you're going to succeed.
Yeah, but I also think about the discipline of saving as well, because let's just say that our tax is 10%, right? So we're paying our taxes because we have to pay our taxes. And say tomorrow, for example, the government says, well, tax is actually 20%. So you can't go ahead and argue with that, because all of a sudden there is another 10%. But what I'm saying is, if you discipline yourself and you're saying, well, out of my paycheck or out of my profits, I have to put aside, I just must put aside 10% for my savings, and whatever that might be, that's when we go to our financial advisors. But if you discipline yourself in that way and say, well, I'm paying for my food and I'm paying for my electricity and this and that, and then this chunk here is my savings, and then the rest is going for other purposes. So I would have thought, as a financial advisor, that's probably where I would be going with my clients and saying commit. And the sooner you start, the better it is, because of the compound interest, because of the years and years being, say, in the share market, because share market historically does perform as, no matter what, 10% growth every year. The same with the property in New Zealand. Like, if you purchase property 10 years ago for $300,000, I bet my last dollar that today it's worth about 600,000. So historically, especially in Bay of Plenty here in New Zealand, it's proven that you would sit on a property for 10 years, you get 100% return. So what I'm saying is there, in your view, guys, David and Mark, is there a percentage we should commit, or the ideal figure that we should commit for those investments and kind of start early and start accumulating that fund?
Yeah, I think, I mean, 15% is often bandied around in terms of being a good number to accumulate from your income for long-term, you know, savings towards retirement. You know, and that might not be a bad benchmark. And certainly from a KiwiSaver point of view, we're a long way from that. So hence it's not the only scheme that people need to have for their retirement. But it does come down to individual needs as well. And so some people might need 15, others might need 20. 10 would be a very good starting point, I would have thought.
Mm-hmm.
Mark, I think you need to share your ninja trick.
And probably start as sooner than later.
Look, I think you should just start with whatever you can afford, but start. Whether it's $1 to $100, it doesn't matter. You can always find money in your current budget, no matter what. And yeah, the ninja trick is something that we use, and I think it's a very useful tool to use. But guys, I do have to warn you that your KiwiSaver will be taken by your government at some point, right? It's a new tax. They've just called it superannuation. It's a no-brainer. We've got 2.8 $8 trillion sitting in our superannuation. Here in Australia, we owe nearly $1 trillion as a government. If I was the president of Australia, I would steal our super, pay down our debt, and I'd still have 1.8 trillion bucks in the bank, right? So the Kiwi government turned around and went, hey, that's a clever idea. Let's set up the KiwiSaver so we can steal that at some point, and we'll call it a retirement fund. They will pay you a pension of probably 200 bucks a week or something for the pleasure of taking it off you at some point. But I wouldn't be putting any money into something that you have zero control of. Just my opinion, right?
I'm smiling, Mark, because I'm with you there. And also, I think 3%, like the lowest percentage people can put aside is 3%. It's a little bit laughable because of the inflation and because of the fees of the providers, and the list goes on. So yeah, I'm personally not a big believer in that as well. So about, you know, talking about government taking it, I don't know, who knows, but I do know that investment is not government guaranteed. So when I have conversations about KiwiSaver with especially younger people, I always say, well, do not rely on it, because this is like a little thing you can pretty much forget about it. You're doing it, you feel good. It's kind of like a feel good thing, but relying on it and betting on it, waste of time.
I wasn't going to bring up the KiwiSaver because I knew this could get turned into an hour conversation. But the and agree with, you know, as a government funded or government gathering scheme. So yeah, government back. So where is it going to go? And what I find interesting, and hence from my questions before, was the banks are now interested in what's in your KiwiSaver. So when they're lending you money in terms of your assets and your income, they're actually asking, okay, how much have you got in your KiwiSaver now? So I've been asking the banks, well, how is that relevant to how I'm going to service it? Because I can't get it out. There's no relevance whatsoever. What do you want to know? Oh, we just want to know what your net worth and stuff is. Well, what's the point? Because that can be taken away tomorrow. So it's quite a hence. You know, will they then go? You know, back to the point about shares and property portfolio and asset classes and.
So David, a couple of points I'd chip in there with. One would be that if you were concerned about the government taking your KiwiSaver, given that it's with not the government but fund managers, the banks, the like,
providers,
you'd also, and other providers, you'd also have to be concerned that they might dip into your bank account or dip into your business and take those assets, right? I'd like to think we're a long way from having a government in place that would be inclined to do that.
Why though, David? Because, you know, she's already got you guys thinking that, you know, you have to take a COVID test, and if you don't, they're going to quarantine you for more. So you've already got a dictatorship happening, and New Zealand and Australia are broke. So at what point do you think that they wouldn't do it?
I think well, certainly what we've seen in the Australian experience, being superannuation being around for as long as it has over there, is that as the amount of money that is in the scheme gets larger, it becomes a very, I suppose, it makes it quite attractive from a taxation point of view, right? You can adjust the tax rate, and suddenly there's you know, there's more money coming in. So that's where I would be more concerned about, is that if there was perhaps a desire there to increase the tax take from KiwiSaver. Now, as it stands, you know, we have a much higher tax rate sitting within our KiwiSaver scheme than what you have over there in Australia, and we've seen some of those tax benefits reduced out of KiwiSaver. We no longer have the kickstart, and the member tax credit is half what it used to be. So it does have, there is that incentive for governments from time to time to look at it as a way of raising revenue.
But see, this is what pisses me off, right? Like when KiwiSaver first came in and I became a Kiwi, I was like, yep, free money from the government, I'm in. At that point, I'm pretty sure there was no tax on it. It was tax-free, or yeah, I'm pretty sure it was. What pisses me off is that they can just change their mind. And this is where I agree with Mark. It's like they can change their mind whenever they feel like it. and do with it whatever they feel like it. So if they go and say, oh, COVID's just put us into a position that, oh shit, we can no longer afford to give the contribution, and we no longer can afford to give you a KiwiSaver when you're 65, but when you're like 75 or 85, there's nothing we can do about it. And our money is sitting in this fund, and you basically can say goodbye to it.
So,
Yeah,
so we shouldn't give her this video.
Yeah,
Well, it's going to go live anyway.
Yeah, sorry, Connie, you go.
No, there's all right, really. I was just saying they hadn't thought about it until they watched this video.
They already knew, you know, like Australia's been calling it superannuation. It's a nice way to say this is a future tax. New Zealand went, hey, that's a good idea. Let's start KiwiSaver. You're a bit behind, without a doubt, but how else are our governments going to pay down the debt that they have, right? It's as simple as that. You don't, and even though you've got, what, 90 million sheep in New Zealand, right? You don't have enough sheep to pay down the debt you have. And the amount of debt that Jacinda's put you guys in is fucking ridiculous. Oh, there's my first swear word for the whole 15
I know you,
minutes.
and you were doing
well.
so well. All right, because this is not going to, we're not going to kickstart this into a political debate.
But it's not about politics. It's about money, right? And that's what you said at the start, that this was we were allowed to go non-PC. Mm-hmm. And at the end of the day, if your government's going to ruin the business, what's the point of being in the business, right? They have seriously, and you know, we were given so much crap about us taking time, but we were trying to soften the economy, soften the blow from, you know, before we closed everything down. You know, you guys have just closed everything down and you're not opening anything up, right? And it's
well, we can't now. That's
and it's
the problem.
going to kill your business. It is seriously going to kill businesses. And that's why I love what you guys are doing about supporting locals, right? But from a monetary perspective, start thinking global. Mm. And that's the big difference between, you know, why I'm no longer an advisor and I want to educate people on what's available out there, right? But I'm a big advocate of the right advisors like David, right? Because not everybody can handle making 15% per annum, making 40%, 100%, because that's available out there, right? The sad part is David can't give you advice on trading Forex. You know, we've got access to automated share trading software that hits on average 20 to 25% per annum. It's going to absolutely pummel portfolios from advisors. And it's been going for 4+ years. So, but poor, you know, David can't give you advice to go check out automated share trading software. Not allowed to in his license, but we can educate people and then they make the decision between what's the new system versus the old system, because the old system doesn't work. It's proven it doesn't work.
What I would say is that, you know, Hobson Wealth is a boutique wealth firm, right? We've got about 75 employees nationally. We take in global research from a couple of the largest investment banks and use that to distill down global portfolios. So I think it's, so clients are getting good exposure to opportunities that may not be available to you, you know, if you went to your run-of-the-mill investment service. But yeah, take your point, you know, like you know, trading currencies and trading stocks is, I guess, is different, and we call it trading as opposed to investing. And so people come to me for an investment service. But if I could just pick up on the conversation we were having before. So if people that have got money in the bank, money in KiwiSaver, money in their business, if what we're currently seeing, you know, from a political point of view or an economic point of view concerns them, it really comes back to that diversification question that, you know, and what we've been talking about before, about not having all your eggs in one basket. And so if you're concerned about what might happen to those investments in the future, it is really important to make sure that you've got a good spread and you don't just have your money sitting in the bank. Because as Mark touched on, you know, we've got the open bank resolution that the Reserve Bank put in place to prevent the idea that the government would come in and bail out a bank in the future. So that potentially means that if you've got your money sitting in the bank, you could find in an economic downturn that did compromise a bank, that some of your money gets tied up and taken to support that bank to reopen successfully. So people don't normally worry about those sort of things when the economy's going well and everybody's making profits and having a good income. They do start to ask the question though when we see the economy going to a recession or a depression, and so it's at that kind of time that you do want to have your money spread, right? And so that maybe is into other assets, whether it's shares or bonds or property, but not just in little old New Zealand, globally as well. So yeah, I think that, you know, we've touched on some interesting points there. We do come back and reinforce the need to have a sound investment strategy.
Yeah, David, I really agree, and it's a good advice. And also what I would like to bring to the table is, to business owners that I work with, your business is your cash cow. And what you actually doing, you actually trying to pull as much as possible from the cash cow into your personal domain. That's where you're growing your investments. That's where you're investing in properties, shares, and stuff like that. And it's almost like when we were talking about providing your personal assets to prop up the business, it's a backwards model. It should be other way around. It should be the business is the one that gives you the tools and the cash to kind of, you know, when you've got limited liability company, it's a separate entity. And that's why we always suggest to structure businesses as a separate entity, which is completely separate to your personal affairs. And you use your, as I say, cash cow to prop yourself. And if something goes wrong with the business, you've got a pool of assets, you've got the investments and stuff like that. So that's probably an advice from me to finish it up.
Well, it should be the vehicle to provide the lifestyle that you want to create.
Exactly right. Flip it around. You don't want to prop your business. Business needs to prop your personal affairs and your personal wealth.
Guys, I just want to share this with you.
Marcus, got a magazine there.
It's
Go
called
on,
International Living. Right? This is one of the best things, David. You could, even if you talk to your clients about it, right? What I realized when I first started subscribing to International Living about probably even 8 years ago, is you don't need millions and millions of dollars to retire on a really good lifestyle, right? There are places around the world for around $1,500, $2,000 per month, right? You can live like kings and queens, right? Not here in Sydney, right? $2,000 a month doesn't even pay half a month's rent, right? But there are places like Thailand and Costa Rica and what have you, that $2,000 a month, you will seriously live really, really well. Not trying to kick you out of New Zealand or Australia, guys, but the key is when you realize that there are other options and you don't need to get to, you know, 200 grand a year to have a good lifestyle, then you actually become more motivated, right, to actually stay on track when you are building your overall portfolio. So yeah, it's just a great, I think it's $100 a year, whatever. And it gives you a real magazine. That's what I like.
I suppose that's a good point, isn't it? That it's horses for courses, and everyone has a different idea of what their ideal lifestyle looks like.
Yeah,
absolutely. All right. So because our hour is pretty much up, and I know we can probably continue talking for this for a while. I had one thought in my mind, and then I'll leave the final words to David and Mark. But my thought process before, when we were talking about businesses and KB7 and all of that, is government is a business, regardless of politics, right? Let's put them away. That government is a business, and if we would run our business the way the government has run their financials, we would have the liquidators in our bank. There's no doubt about it. We would be chased, we would be closed down, and we would have lost everything, because that's just the way the business, the millions we've made in losses, etc. Anyway, I just wanted to put it out there because that is something which I'm passionate about, business. But Mark and David, before we leave, can you, for people, our business owners who are listening here in the Bay and going, okay, I've got this money, or I want to contribute my profits, or whatever it is, to start an investment strategy, or I want to review my investment strategy. Do you have a tip or a call to action or anything where you go and say, start with this? And David, I'll start with you. Mark, you have to wait.
Yeah, I think the first place to start is to have a conversation with an advisor. So, hey, look, as a business in Tauranga, we've got capacity to bring on plenty of new clients and give them a really highly personalised service. So I'd encourage you to reach out to me, and I'm happy to catch up to have that conversation. But think about the sort of things that interest you about investing as well. Plenty of people don't want to invest in the things like tobacco and controversial weapons and all of that, but also think about the things that interest you. And what is happening as a result of this downturn and the lockdown and things is that the pace of innovation is accelerating. And so, you know, if you think, you know, the internal combustion engine is basically old news, and it's electric vehicles, autonomous, battery storage, DNA sequencing, robotics, you know, and blockchain are key growth platforms for the future. You know, and those are going to play a role in people's businesses, and they probably should play a role in their investment strategy. And that's certainly something that we can talk to people about. But yeah, have a conversation with me, and we can talk about it more.
Awesome. Mark?
Look, I think you just got to get educated. That's the key. I think that, you know, to be truly successful and end up where you want to be, you have to be in control of your assets, be in control of your wealth. You know, you're not having them all in portfolios that are on, you know, paper or in, you know, in the cloud isn't always things. Sometimes physical things like gold, silver, actual having those bars at your disposal is something to look at. I want you to, and I think people have to be really more open to other alternate views, because when you really look at the world right now, the old system's not working. The old way that we invested isn't working. The old way that we've done business in the past hasn't always, and potentially isn't going to continue to work. Economically, government's not working. So start thinking about what you need and what team you guys need, because you cannot do this by yourself, right? Whether we keep traditional advisors on your team for seasons, you know, or, you know, 90-day slots or whatever it may be for you guys. But you're going to need business advisors. You're going to need better people in your team that understand what's going on, right? More than ever before.
Awesome. And if anyone
completely.
wants to reach out to Mark or know a little bit more about the International Academy of Wealth, you can email me, the sidekick here in New Zealand,
Yeah.
kicking about how, do you like how I delegated your job to me?
That was perfect.
I know, right? So if anyone does want to get educated, or like if anyone wants advice, please reach out to David, because he is a financial advisor and can give you advice around what is happening. If you guys want to get educated and want to take responsibility for your own investments and do your own investments, then please feel free to reach out to the International Academy of Wealth, so me at this stage, or Mark, and we can share with you guys how that works as well. But thank you both, David and Mark. I really love this conversation. I love how passionate you both are about money, about the fact that you were so open. Again, none of this was advice. All of this was an opinion and a view. So please don't take everything out of context and go out there investing into crazy things without having your strategy in place and being educated or advised on properly. Thank you so much. I really appreciate the hour. I've learned so much from both of you. David, we are looking forward to seeing you tonight at the event. And Mark, I'm sure we'll hear more from you as we progress.
I hope so. And let's open these borders so we can come and have some beers, right?
Absolutely.
And thanks, Tim. Thanks for your comments, mate. I've been enjoying them.
Yes, absolutely. Tim, thank you for joining us. And I will see you guys. If I don't see you in person right now, I'm sure we will see each other soon. And the next session is next Wednesday. So we are continuing with those, even though we are already way past COVID and can't even remember what COVID was. Do we remember what COVID was? I don't know. I don't. But we are here to support each other. That's what supporting locals is all about, the community. So as you're watching this, feel free to pass a comment. Let us know who's been watching. And if you have any questions for David or Mark, they're both in our group. So feel free to comment below and they will respond to the questions as well as they come in. So just take them in your questions.
Definitely.
Fabulous. Thank you. I will see you guys soon.
Thank you so much, everyone.
Thanks, team.
Bye.
Bye.
Thanks, guys.
See you later.